Hey, LaVernne and James and Gail. Terry Dyer here. How's everybody doing? Hey, I just wanted to go over a couple questions that might come up with the underwriter, and there's really no place to start in the beginning. So, there's no real beginning, but I noticed one of the things I noticed when I'm looking through your information that you sent, LaVernne, was a couple of these withdrawals for $4,000 each. I haven't looked at any other statements, bank statements, but I do know that any underwriter is going to look at that and want to know where is that money going to. So that's pretty standard stuff. And then I went and calculated what an income would be, what a payment would be for you guys. So let's go over here. Let's get rid of all of these people. There we go. So what I did was I took, let's just assume a purchase price of $525,000, and I have a loan to value of 97%. So that means that you have 3% down. So 3% would be, the difference between 525 and 509. So you have to come in with about $15,000 to $16,000. This would be an FHA loan. And the downside to an FHA loan, the upside is you can come in with, next to nothing down. The downside is because they're so little down, they have mortgage insurance. They, as in the FHA, because the loan is insured. And so they have what's called an upfront mortgage insurance premium, which is 1 3/4% of the loan amount. That gets added to the loan. You don't come out of pocket with that. And then there's a monthly mortgage insurance premium, and I'll cover that with you in just a second. So anyway, going forward on this, how I price your loan or how your loan would be priced. And keep in mind when you're working with a company like Hanson Loans, we're a broker, so we work with a ton of different lenders. It's not Hanson Loans whose loans you'd be looking at. It's, well, for instance, on these loans, a high balance, we'd be going to Cardinal or Caliber because they're the only ones doing a 97%. But if we did a 96.5, which is the standard FHA, then let's see what happens with the number of lenders that comes up. There we go. So the FHA 96.5% loan to value or 3.5% down payment is pretty typical. And then what happens is we get up there into the interest rates. So let's see now at the interest rates, and you can see down here in the corner that we work with a lot of lenders that you probably heard of. For instance, Quicken Loans was there just a second ago. But right now, Caliber is back on top as being the most aggressive. So, and I say that because they're at 4 and an 8, they would be paying you $6,000 for your closing costs, and they pay Hanson Loans 1.375% of the loan volume that we send in there. We're never paid based on an interest rate. What that means to you, of course, is that whatever your interest rate is what it is. It's not manipulated so as to enrich me, the loan officer, or Hanson Loans. If the interest rate goes up from 4 and an 8 to 4 and a quarter, so does your rebate, not my income. My income is based on, or the income for Hanson Loans is based solely on the loan amount. It has nothing to do with interest rates. So why is this over here important? Because we're going to use this to pay your closing costs. Closing costs are things like title insurance, escrow, and underwriting, and all those fees, and those come out to about $4,000 or $5,000 easily on a purchase, probably a little bit more. So we'll use this money to pay those costs and give us a rate of 4 and an 8. A payment of $24.98 is what it says right here. So let's assume we're going to be somewhere in just over the 4% range. And then we'll come over here and look at my underwriting program. And so what happens is I put your information in here, a little bit of information that I have. And there's my picture down there. Can't see it. Let's see if I can. All right, good. All right. So anyway, so over here at 4 and a quarter, this would be 3.5% down. So the 3.5% is about $20,000, right? And sometimes, perhaps Gail or when Gail writes your offer, occasionally the lender or the seller would contribute some closing cost out of the purchase price. So that's always a thought. But if not, it is what it is. So then you have the mortgage insurance premium. Remember I told you that let's start up here. You have your appraised value. Let's assume you're buying a home for $550, so it appraises for $550. And then you have 3.5% down of that's $19,250. So that gives you a loan amount of $530. And then the FHA, because of the FHA loan, they charge 1.175% MIP, which gives you mortgage. That's a mortgage insurance premium, and so that gives you a loan amount of $540,000. So based on a $540,000 loan amount at 4.25 times 30 years. Your principal and interest payment is down here at $26.56. Okay. Now you're going to want to insure your home with, obviously fire insurance, flood insurance, all that other stuff, hazard insurance. So that's going to be could be $80, $100 a month. And then of course, when you're a homeowner, you have those costs of home ownership. One of those being, aside from hazard insurance, another would be, of course, property taxes. Property taxes are typically calculated at just over 1% of the purchase price, 1% of the purchase price divided by 12. So if you buy a $550,000 house, to take $550,000 times 1% divided by 12 equals $550 a month or something close to that. Anyway, the math isn't that important. And then coming over here, you have that FHA mortgage insurance, which is pretty steep in my mind, of nearly $400 a month. So the price to pay for being like normal people and not having a pile of money put down is that you use the FHA loan, and the cost for the FHA loan is $375 a month for that insurance. And the only way to get out of that on an FHA loan is to refinance out of it. Okay, so this is how the FHA works, and that's why you would use it so that you could get a low down or no down home loan. So what happens here is you look at your debt ratio. Now I base your debt ratio on assuming that the only bills you have on your credit report is that car loan and a couple of revolving payments, for charge cards or whatever. So about $500 a month, not much more. So when adding the $36.62 and the $500, that's only 33% of your gross income. So you pretty well qualify for, easily qualify for $550. You'd probably go to $600 if you wanted to. But the problem is, the higher the purchase price, the more the down payment, and, of course, the higher the payment. So, I think that's it. Those are the payments. That's how it works. That's what it would look like. And then, of course, we did the calculation for how we come up with those payments. And here are all the lenders down here that I work with. Well, that's not all of them, but it's a bunch of lenders, so you can see that it's not as though, you're going to save time by going out calling these people one by one, trying to save a little bit of money on your loan. But anyway, that's not the point either, is it? So anyway, that's your introduction to how the loan works, you guys. And if you have any questions, of course, give me a call. Thanks. Bye.